If you are an investor or shareholder of Norwegian Cruise Line Holdings, or if you are a passenger who lives for the Avon, Oceania, or Regent, I have news for you. And honestly, it's the kind of news that makes you want to double-check the structural integrity of your wine glass. A massive 10% stake in NCLH has just been snatched up by Elliott Investment Management, the activist ninjas of the financial world. They've sent a 59-page manifesto to the board that basically calls NCLH's management a lemonade stand in a coffee cartel world. Today, we're doing the heavy lifting to see if your champagne lifestyle is about to be budget cut or finally polished to perfection. But you know me, all the data can be found in the link in the description. Check it yourself. Now, let's talk money. If you're a shareholder, you've probably noticed that while Royal Caribbean and Carnival have been sailing towards the moon, NCLH has been, well, circling the harbor. Elliott's data is brutal. They point out that NCLH has underperformed its peers by a staggering 230% over the last 3 years. Why? Because the back office is bloated. They are spending $102 per passenger day on administration and marketing, while Royal Caribbean does it for $86. My take for investors: this intervention is a godsend. They want to unlock $550 million to $825 million in annual savings by trimming corporate fat, not guest stake. They've even brought in Adam Goldstein, the former president of Royal Caribbean, an absolute industry royalty, to help steer the ship. If they hit their $56 stock price target, your portfolio might finally afford that grand voyage. But let's pivot to what matters to us, the Oceania and Regent experience. This is where it gets spicy. Elliott is looking at Oceania and Regent and asking, why are we not making more? Paradoxically, even though these brands are performing well, Elliott thinks they are being undersold. What about Regent's all-inclusive halo? There is a fear among my fellow ambassador-level cruisers that Elliott will apply the Southwest Airlines playbook. At Southwest, they pushed for bag fees and assigned seating. For Regent, could this mean unbundling shore excursions to raise margins? If my included excursions start looking like a basic economy flight, we're going to have a serious problem. How about the Oceania value gap? Well, Elliott argues that NCLH has failed to differentiate brands. They believe the core Norwegian brand is trying too hard to be premium, which actually cannibalizes Oceania's value. And the infrastructure strategy. They are furious about Great Stirrup Cay. While Royal Caribbean has Perfect Day at Coco Cay printing money, NCLH's island won't have a pier or pool until late 2026. For Oceania and Regent guests, this means years of tendering to an island that feels like a construction zone while paying premium prices. Look, I've extrapolated the numbers, and here is the real deal. Elliott isn't trying to turn Regent into a budget line. They want disciplined execution. They want to cut the $3 billion capital expenditures on ships we didn't ask for and spend it on the things that actually matter, like making sure the butler doesn't just tuck you in, but actually knows your espresso order before you do. The risk isn't that luxury will be cut. The risk is that it will be monetized more aggressively. Expect higher prices for the Avon and fewer freebies on Oceania, but hopefully a more polished, professional ship that stops making strategic missteps, like flying pop stars to Iceland for ship launches, while the private island sits empty. Okay, closing. So is NCLH finally getting its act together, or are they throwing traditional cruisers overboard? I've done the data crunching. Now I want your feelings. Drop a comment below. Are you buying the stock, or are you booking a cruise before the unbundling begins? I'll be sipping my French press and keeping an eye on the spreadsheet so you don't have to. Don't forget to subscribe. We're chasing 5,000 now.